Welcome back, and thanks for joining me for the second part in this series of some of the business owner videos that we've got to help you. And today I'm pretty much talking on an often misunderstood topic of superannuation. It's something we have to participate in, but there's a lot of things about super that a lot of people don't understand. So today I'm joined by Dave Henriksen, the guru of all things super. And Dave, you might want to give everyone an understanding of your role and why we're talking.
Thank you, Andrew. Thank you for the kind words, of course. What I do in PKF, I'm the partner for Super, for the Self Managed Super Fund accounting division, and also sit as one of the advisors there in the PKF Wealth team. And I'm fortunate enough I get to help people with the noise, as I call it, of super and the complexity of super, and simplify it down to help people have the right strategies to make the most of their super. Ultimately, we're dealing with strategies for both people with starting out, but also people with a lot of wealth and a lot of structures where they need the complication unravelled and really help make sure that what they've got in place is not just achieving their goals today, but achieving the goals in the future. And the end goal, unfortunately, we all have a death event.
Yeah,
so
sure.
Also considering the estate planning as part of that as well, and working with the estate lawyers. So,
and it's fair to say that, you know, while super is, from an individual perspective, superannuation, a lot of your clients are business owners, and a lot of the things we're trying to achieve around that, I guess, goal of an individual in superannuation often comes from the business.
Correct.
Yeah. So tell me, I'll put this one out there, it's in the media a fair bit, but can anyone give advice on superannuation?
No, and traditionally accountants, as I am as well as an authorised advisor, accountants could give advice on a self-managed super fund and set them up. But a few years ago, with all the noise that's been going on with people having super funds and spruikers of self-managed super funds to do properties and borrowing for mum and dad investors that might not be ready for that, they legislated that accountants can no longer actually give advice or perceived advice on super. So now it's pretty much moved from being something that an accountant and an advisor can advise on to just being someone with an authority to give advice through a licence or an authorised.
So you don't just necessarily take advice from your mate down the pub?
No, and what we've found, unfortunately, is that some of those people that have taken that advice and set things up on their own without getting good sound advice, and sometimes they come to our firm and we look at what's set up and we say, look, I hate to tell you this, but what you've got is really the worst thing you could have done.
Yeah, sure.
But now you've costed on it, we might not be able to undo it very easily.
So first tip, make sure the people you're talking to actually understand and have experience and runs on the board of what they're giving advice on.
Definitely.
All right, so I've got a few questions for you on this topic that not too technical, but really want to get punchy to help the business owners that may be listening. So from, I guess straight to it, what is a business owner's obligation around super, as in the superannuation obligations and amounts, that sort of stuff, what they have to do?
Yep, so generally speaking, a business owner has to pay super guarantee for their employees. They have a quarterly obligation to pay that. They also need to make sure that they're calculating that super guarantee, which is currently 9.5%, on the right base salary and other bonuses and so forth. So I think that's where, from our accounting team, they can help those business owners calculate that. But apart from that general obligation, I think a good business owner who wants to keep their team and staff engaged, if they show let's call it a care factor on what super that they're having as a default fund, because we see a lot of, the Royal Commission...
Hang on, what's a default fund?
Well, a default fund is effectively a super provider that the employer has said, if you don't tell us where you want to go, this is where we'll put your super, and there'll be an application form to put your super into that.
So effectively, if you don't check it out,
yes,
you could be putting your money with anyone that, all care, no responsibility, and no real say in really those goals you've got for wealth creation and your superannuation into retirement.
Correct. So a poorly chosen default fund as an employer, you could actually be doing your staff and team members a disservice. You could be leaving them worse off for having made that choice.
So you mentioned about having that care factor around your employees, or your team. Default fund, I get that. But my understanding is also it can be quite a tool in your kit bag, if you like, to use superannuation in packaging and really as a retention and a attractiveness for recruiting.
Definitely. So we've seen examples where employers might pay more than the minimum 9.5%, and that might be an incentive. It's very tax effective, especially on a higher income. They might not be at the income where they're maximising super contributions, but say the default position for an employee is that you're paying them 9.5%, you might be paying them 9,500, keep it easy. But instead of paying them 9.5%, you might pay them 10 or 11% as an initiative. And because they're in that higher tax bracket, they're actually better off, because if they take that extra pay home, they're going to lose more of that to the taxman than if they have it going into super.
Okay, and you talk about this super guarantee.
Yep.
9.5%. Is that 9.5% no matter how much you're earning?
No, there is a carve out that once you're earning over a certain amount, that there's not an obligation in most industries unless there's an award, and that indexes up every year. It's still below 200,000 at the moment. I can't remember the exact number today, but
that's all right. I won't hold you to it.
It indexes up, so the employer only has to pay super guarantee up to a limit. Okay. And then after that, it's a discretion unless it's hardwired into the agreement or the award.
Okay, so a lot of your clients, as we said before, are business owners.
Yep.
So is there any differences for, self-employed people wanting to contribute to superannuation?
Well, what we find a lot of the time is that self-employed people, especially if they're running their own business and they're putting all of their capital, all of their money into the business, they sometimes don't pay much super for themselves. If they're not paying themselves a big wage, they don't have the super guarantee obligation. So super definitely becomes a forgotten aspect while people are growing their businesses. Once the business starts getting successful and getting good cash flow, if they're not in the habit of paying super, sometimes they forget that. So without some good advice and good holistic strategy, they miss a huge opportunity to, again, put wealth into a very tax-effective environment that's also building their wealth for retirement. And what I've found, and even some recent conversations in this week with business owners that are very successful, diversifying themselves from a risk factor. Having all of your wealth just in the business is great. It might make you a huge amount of money, but sometimes there is still risk in business. So a
lot of time there's risk in business.
There is. So business might be giving you a great return. It might be giving you a 20% or 30% return. And you go, well, I can't get that investing in the market. But there's a risk that might not continue forever.
Yeah, sure.
So shifting some wealth strategically into a super environment or other tax-effective structures and diversifying into other areas that aren't related to your business, you're actually giving yourself a better risk management outcome.
Yeah. Now, on that point, you're saying get in the habit of regular investment, I guess, but I remember back when my parents had a small business, and from the point of view of your work, you've got bills to pay, etc. Always traditionally, when you start thinking about retirement, which is sort of that 50s sort of age bracket, then they start to really get serious about superannuation. Is that still the way you can do it?
It's challenging because we have got contribution limits.
Contribution limits?
Yes, so we're limited to how much money we can put into super every year. So from a tax deductible type of contribution, which includes your super guarantee from your employer, includes personal tax deductible contributions, an individual can only put in $25,000 a year.
Yeah, right.
As well as that, we can also put what's referred to as after-tax contributions, or the technical term being non-concessional. It's $100,000 a year. So they're not big dollars. And when you think about on retirement, unless we are super wealthy, most people need a pretty significant nest egg to be able to retire comfortably unless they want to rely on the age pension. And I think there's a real risk that with an ageing population in the country that the age pension is not going to give you much more than the basic standard of living.
Yeah, there's a fair few stats that I've seen around the baby boomer cohort particularly, and how many people will be in that retirement period of their life versus how many people are actually working, generate the taxes. And you'd rather take your future into your destiny around your retirement planning and your wealth for that matter. So I guess the message there is you can only put that amount in each year, you can't afford to leave it to late. We've got to start earlier and having a conversation we probably traditionally haven't had with a younger generation.
Yeah.
Okay.
Just to that point, you get to 60 and you go, I'm going to start thinking about it now. To my example, you're going to be very limited to build much super at all. You'd be lucky to get anywhere near $1 million into super if you have the cash flow at the time. And to have a reasonable lifestyle, you probably want to be able to get 80,000 or more than 80,000 out of super as an income. Well, you want to have 1.6 to 2 million in there.
Which most people wouldn't get near if you just did your maths on
exactly right.
25 or less a year.
Yeah. But the power of compounding and starting early, or at least drip feeding in, even the business owner that's not quite successful yet, if they can get a little bit into super and just let it grow over time, invested in a diversified way, they should still be able to grow that really well over a 40-year period or a 30-year period. Much easier than trying to do it all at the end.
And not to go into detail, but obviously superannuation is very tax effective too compared to non-superannuation environment. That's correct?
That's correct.
So for me, I think the message I take there is for anyone, but especially business owners, you really need to plan and plan earlier if you can to reach those goals you might have after the business is sold.
Definitely.
Whilst we're on the business, so I guess there's this thing that, and not to go into detail again for our viewers, but the small business CGT concession. So to me, that's another way you can get money into superannuation. Tell me about that.
So that's a handy feature that's in the tax system. So the small business CGT or capital gains tax concession is available for a business owner to make a top-up contribution when they've sold a business or sold a business asset. Now, it is limited to people who have assets under $6 million outside of super, but we find that most business owners, smaller business owners, will access that. So they might have invested all of their money in their business over the years. They haven't been able to get enough into super. They do sell the business or sell a business asset, and they might be able to put in $500,000 under the exemption, or under a 15-year exemption, they could put over 1.4 million in.
And it's fair to say with, again, planning, so I think this is a constant message here, but planning, that might even be when they sell. They could bring that forward and actually trigger a sale.
Correct.
While they still qualify. And I mean, that's obviously under current rules, but it can be quite effective with a bit of time on your side and a bit of planning.
Well, to that point, if they have an expectation that they're going to grow past the 6 million asset test, if you can trigger something before you've grown past that and get that money, and that's a good idea to explore. But if you do go over the 6 million and you're not too far away, there are some other strategies with some good advice where we can shift where wealth is so that you could still qualify legitimately without being any avoidance or anything like that.
But it's fair to say it can't be done overnight.
No, it can't. It needs good planning.
So, we read about, and you've already mentioned during this quick talk about these things called self-managed super funds. What are they? Why would I have one? And probably when would I have one?
Okay, so I talk to this all the time with people. So the general point is a self-managed super fund is a special type of trust structure.
So it's not one of these?
No, it's not one of these. It's very much independent of that. So a self-managed super fund is a special trust where you take on the duties of running your own super. And you as a trustee of your super fund have to adhere to obviously a whole set of legislation, which as my colleagues joke about, I sleep with the legislation next to my bed. But it is such an important thing that if we manage it, if we take control of our own super, we have to make sure that we're then adhering to those rules.
So why would I want to have control of my super?
So that you can make other investment choices that you might not get in your default super fund or any other fund. So you in a default fund, you're only investing in shares and whatever that particular fund is prepared to invest in. Where you might have an opportunity to buy a property that is in your interest to buy, a business property to run your business out of, or a residential investment, which again I wouldn't encourage, but again, if sometimes people find good opportunities. It might be to invest in a unlisted trust. So again, someone might be doing a pooled group of people wanting to do a big property development. Or
so you can use your super for that?
Potentially, yes.
It depends.
It does depend. It does depend. Or investing in a unlisted company. So you might be part of a like group of people that want to invest in a company and you only have a small piece.
Yeah, sure.
But the opportunity is that company could skyrocket, and that would give you a better opportunity than just being in a standard fund.
And there'd be other things like, can you invest in businesses and that sort of thing?
To a point, there are some limitations. So you can't wholly own in your super fund an operational business. There are some restrictions which I won't bore you with today. But generally
again,
speaking,
you need advice.
You need good advice and good strategy around that. So we meet a lot of business owners where there's independent family groups that share ownership of a business. And sometimes we can do some really good strategies where they have a super fund each and co-invest in a way that they can open up their options.
Yeah, sure. So, what I'm hearing there for a self-managed super fund is if you like control, great opportunity. If you like to invest in quite a number of different asset classes as opposed to probably the more traditional down with a managed fund or a public fund. So would anyone have one? Like, would there be a level of superannuation, dollar amount that I would have to make sense of this?
Yeah, so that's the final piece of why you would look at a self-managed fund versus where it might be currently. Once you get to a certain wealth level in super, it starts to become more cost effective because you can control the costs in your self-managed super fund. Whereas in an industry fund, a retail super fund, all the different super products that are out there, a lot of them tend to charge a percentage-based fee.
I didn't think they had fees.
No, well, they say that, but in the background there are fees that sometimes aren't always showing.
Okay.
But super, you can control that because you are in charge. So if you choose to pay for advice and have someone to invest a portfolio, you can turn that off anytime you like. You can sack that person if you're not happy. You can't sack the advisors in the default fund that you're in.
Yeah, sure. So it sounds like from and I know there's limitations around the number of members and that sort of stuff, but from a self-managed super fund, that'd be probably attractive to a lot of business owners.
Definitely right. And from a pure cost comparison, I tend to say to people, if you and your other members, so you can have up to 4 members in a self-managed super fund, they are trying to legislate to go to 6. I tend to say for a pure cost, 400 to 500,000 is a good pooled value where it becomes really cost effective, depending on what you invest in. Anything below that, it's probably going to cost you a little bit more to run the fund than it would be to leave it where it is if it's in not a high cost.
So therefore, but it's more a discretionary thing around control and asset classes. Okay, so picking up on one of the assets you said there, probably my final real point for you is around the property in super. Okay, I think most Australians, well, probably more than just Australians, but people love property. They can touch, they can feel it, etc. So we can use our superannuation, self-managed fund, to buy into property. Okay. So we can borrow with our super fund.
Yeah, so you can borrow through what's referred to as limited recourse borrowing arrangements, short version LRBA. There are a lot of strict rules around what a self-managed super fund can borrow for, how it can borrow, what level of security you can put over the assets of the fund and the asset that it's buying, what improvements that it could or couldn't make on the property. But generally speaking, a super fund can, again with the right advice, borrow to buy an asset. Not 100%, you can't do 100% borrowing, but you can leverage into a property, which is really handy for the business owner who might have, let's say, $500,000 super balance and a business property that they already own somewhere else. They might want to shift it into the super fund. Or they need a new premises for the business and the business is going well. We would never suggest someone with a failing business do this, but if someone's business is going really well, cash flow is great, they need an extra site or a new site, we might explore with them about buying that via the self-managed super fund.
Okay. And the banks support this?
A lot of them have stepped out of it in recent times, especially in the last 12 months, but a few more have said we are out now. All the majors have effectively stepped out of borrowing. You can still get loans through second and third tier and the occasional, again, if it's a really big fund or a big asset, you might get it through with the other banks. Yeah. But generally they're a bit gun shy of it at the moment because of the media and the noise.
So in the interest of time, thanks for a lot of your contribution there, but some of the takeaways for me for business owners and non-business owners, but I guess superannuation, fairly complex area, but can be quite a strategic area in business for your employees.
Definitely.
Really around attracting them, looking after them, giving them a bit more. I guess make sure you're dealing with people that actually are accredited, are experienced, and have runs on the board.
Yep.
Give yourself time. That'd be probably a key takeaway here. And superannuation by nature is a longer term investment.
Good. I'll draw on that for a second. The best example is don't ring up your accountant or your advisor and say, "I found a property, I want to buy it in a self-managed super fund. Can you set it up today?" You really need to plan that out. You're better off having set the groundwork and foundation before you ring up your advisor.
So have an overarching plan.
Definitely.
Okay. Make sure you understand what you're paying and your limitations and where your default funds are.
Yep.
For me, how can you use it in your business if you're the business owner from wealth creation?
Definitely.
You know, look at that small business CGT concessions, not just if you're selling a business, that should be part of your wider plan as well.
Yes.
Because it's a good top up into super, but it's also a good tax strategy as well. SMSFs, you know, if you like control, if you like a lot more asset class options to invest in, SMSF could be for you, but again, seek advice. And particularly on that property space for the business owner, if they're looking for real business premises, we could look at a limited recourse borrowing arrangement.
Yep.
Fair summary?
That's correct, yeah.
Okay. I think the final thing for me is that most people look at superannuation itself as the investment, where realistically superannuation is just a vehicle to allow investment.
Correct.
And by nature of superannuation, it is a longer term play. So if you're expecting to make a lot of money overnight, you know, we hear all the the rainbow moments and that sort of stuff, but reality is a good plan with a lot of time is going to get you in a better position.
Agreed.
Yeah.
Definitely. It is a long-term investment, and sometimes in the earlier years, to your point on setting up a fund, you might not have that golden number of 400,000 or 500,000, but if you're about to buy an investment that's going to be there for the next 30 years, you might accept that it'll be more costly to have the self-managed super fund today, but the longer term growth of that investment will mean it was the best place to have started it in.
Yeah, sure. That's good.
Yeah.
Well, Dave, you've taught me a bit about super today, and probably take a fairly dry topic in most people's eyes. There's a lot more to it, and one we need to explore a bit more, but thanks for your time.
Pleasure.
Thanks for joining me.
Thank you.
And thank you. Cheers.